Welcome to Standard Chartered India Money Insights, a podcast series that brings you topical insights and local perspectives on India's markets from the experts.
Hello everyone, welcome to the first episode of What is Driving the Market for 2026, where we will look at key market events and address key questions on investors' minds. Hi, I'm Vinay Joseph, the host for this episode of the podcast. Now, with the presentation of the budget this Sunday, investors' minds would be on what are the key takeaways and should they change their position of their portfolio given the budget. First, we see 4 key outcomes of the budget. First, slower pace of fiscal consolidation. Fiscal deficit for the fiscal year 2027 is forecasted at 4.3% of GDP, a modest 10 bips reduction versus the targeted 4.4% for fiscal year 2026. This is the slowest pace of fiscal consolidation since the pandemic. However, gross borrowings or government paper supply came in much higher than market expectations at close to 17.2 trillion INR rupees for the fiscal year 2027 versus 14.6 trillion versus for the fiscal year 2026. Second, we saw a renewed focus on capex, with forecasted capital expenditure expected to grow 12% over FY fiscal 2026 at 12.2 trillion for fiscal year 2027. This was led by defense, which is expected to grow 17% year-on-year, state loans for capex expected to grow 33% year-on-year, and railways at capex expected to grow 10% year-on-year. Third, the budget marked a shift in government policy focus towards sunrise sectors like semiconductors, electronic manufacturing, biopharma, and data centers, as the government looked to reduce not only import reliance but also strengthen India's position in global supply chain and create an edge in high-value industries. Lastly, there were few minor tax changes. While higher STT on options and futures was clearly a negative, buybacks to be treated as capital gains was mildly positive. The budget also included some concessions on MAT, lower TCS for certain items, and simpler tax administration for individual payers. So overall, what does this mean for investors? First, on growth, in our view, the budget supports the broadening of India's economic revival, which was a key highlight of our riding the recovery wave theme for 2026. Now, the slowest pace of fiscal consolidation since pandemic and the renewed focus on capital expenditure supports a broadening of GDP growth, as the ensuing consumption-led recovery is supported by a revival in private investments. Further, the budget took steps to improve manufacturing and service sector competitiveness, strengthening India's long-term growth prospects. Now, when we look at asset class, we remain very constructive on Indian equities, as a reflating economy with nominal GDP growth moving to double-digit supports a corporate revenue outlook. Earnings is likely to revive, with the Nifty Index EPS estimated to grow closer to 16% over the fiscal year 26 to 28, compared to 5% for the previous 2 years. And 3, rotation is likely to take place into Indian equities by foreign investors on attractive relative valuation to peers, amid underpositioning towards Indian equities by foreign investors, and also rotation by domestic asset allocators, given better relative valuations for equities versus bonds. Within equities, we remain overweight large cap equities, as they are likely to be the first beneficiary of these above conditions. However, bond yields are likely to move higher. Higher than expected supply of government paper and the slower pace of fiscal consolidation, both much higher than market expectations, is likely to pressure bond yields in the near term. In addition, RBI's rate cut cycle is nearing its end, and demand-supply dynamics are weak in the absence of aggressive OMOs by the RBIs. These are additional headwinds for bonds as a market. We continue to like bonds over cash, but within bonds we are overweight short maturity bonds given lower interest rate sensitivity and attractive accrual opportunity compared to medium and long maturity bonds. So finally, in short, we see the budget maintaining a balance between fiscal consolidation and prudence and supporting growth through higher capital expenditure. This supports our Ride the Recovery Wave investment strategy as we see a broadening of GDP growth, driving an earnings revival and leading to a rotation into equities. That's all for this edition of the podcast. If you would like a copy of a Market Watch, please reach out to our relationship manager, or you could find it on our website www.sc/co/in or on SC Invest. Please like and subscribe if you find the podcast useful. Thank you.
Thank you for listening to Standard Chartered India Money Insights. Stay tuned for the latest updates and market trends by subscribing to our podcast. For more information, reach out to your Standard Chartered relationship manager or visit www.sc.com/in.